It continues to be such a blessing to get to work with such amazing people. And speaking of amazing people, since it's been a day of great thought and discussion and bringing some of the state's greatest economists to town, well, it would have to, of course, be that our own chairman of the board, who also happens to be an economist, is here as well to introduce our speaker. Of course, we all know Dr. Wendy Lee Graham, who graduated from Wellesley, got her PhD from Northwestern. We have forgiven her for all of that because she started her economics career at Texas A&M in 1969. Where I know it, we had to mention A&M. It just is part of TPP. I'm so sorry. She taught economics at Texas A&M for 8 years, and of course, after her husband, U.S. Senator Phil Gramm, was elected to the United States Senate in 1984, she served as the executive director of the Presidential Task Force on Regulatory Relief, and later as the director of the Federal Trade Commission's Bureau of Economics. Of course, we all know also President Reagan has called her his favorite economist and naming her chair of the Commodity Futures Trading Commission. Please help me welcome, with such a great round of applause, our own Dr. Wendy Graham.
I know. Thank you and welcome. I hope you enjoy this morning's sessions. You know, this has to be somewhat of a first, as Brooke said earlier, to have all these economists in one conference at one place talking about the Texas economy and issues important to Texas's future. And that is a TPPF dream that we had a long time ago, and that is to get folks to get together and talk about the issues that are important to Texas and to our future. So thank you all for being here. Now, because of the importance of this to Texas and to TPPF, you know, TPPF wants to really inform the discussion about how to keep Texas growing and providing jobs and opportunity for the future. And so we had a really good discussion about that this morning. But the thing that really pleases me today is that I get to introduce someone who's really been at the forefront of talking about the Texas economy, and with a mighty big megaphone, and that is the president of, and it's officially called, the 11th District Federal Reserve Bank at Dallas. Not of Dallas, at Dallas, President Richard Fisher. Now, I want you to know that he had a really great career both in the private sector and in the public sector before he became president of the Dallas Fed in 2005. In the private sector, he was at Brown Brothers Harriman, and then started his own companies at Fisher Capital, Fisher Ewing Partners, and then more recently was vice chairman of Kissinger McLarty Associates. In the public sector, he first served way back when he was a kid in the Carter administration as assistant to the Secretary of the Treasury, and then in Clinton II, that is the second Clinton administration, he was Deputy U.S. Trade Rep, right? Now, as Deputy U.S. Trade Rep, he not only implemented NAFTA and negotiated a bunch of other trade deals, but he also received the rank of ambassador. And once you're an ambassador, you're always an ambassador. So when you get tired of calling him President Fisher or whatever, you can call him Mr. Ambassador. Now, Ambassador Fisher also was, shall we say, he grew up in Mexico. He started at the U.S. Naval Academy, got seasick, so he transferred to Harvard. Well, I don't know if he got seasick or not. Maybe he never got on a boat. But anyway, he transferred to Harvard and graduated and majored in economics there. And he also then got his MBA from Stanford after spending a couple years at Oxford studying Latin American politics. But there they call it reading. I guess you were learning to read there too, which is a good thing. At any rate, we're delighted to have him there. He's not only president of the Dallas Fed, but he also is now a voting member of the Federal Open Markets Committee. And let me tell you what, from what I understand, he's been voting right for Texas on those issues. So please help me welcome President Richard Fisher.
Boy, what a pleasure to be introduced by really one of the most brilliant women in America. And I noticed Brooke said we've had a lot of notorious economists this morning. I'll fall in the notorious category. She falls into the glorious category. And I'll tell you, this is a pleasure. Brooke, you've been very nice. You've invited me a couple times. I told Nancy, my wife, that I was going to speak to this group today, and as you may know, her father was a Republican Congressman, Jim Collins from Texas, and a very close friend of Senator Graham's. And then I said, and I'm going to be introduced by Wendy Graham. In your wildest dreams, did you ever imagine that I would be going down to Austin to speak to this prestigious group with some remarkable legislators and be introduced by a fellow Wellesley grad, Wendy? Her reply was the great leveler of all time, Wendy. She said, Richard, we've been married 41 years. You don't appear in my wildest dreams. So, here I am. Now, I want to do 4 things today, and I'll try to make this quick. First, I want to give you a little orientation about the Federal Reserve because it's poorly understood, particularly the Federal Reserve Bank of Dallas, meaning the 11th Federal Reserve District. And secondly, I want to talk about where we are with the U.S. economy, just to give you a little orientation. Then I'm going to give you quite a bit of Texas brag in terms of how we are performing. And then I want to conclude with a question, which is really a disguised suggestion of something that I think those that are really concerned about the future of Texas are going to have to grapple with, and there's some very tough decisions to make. So let's start with the basics, and I hope these slides will work here. I think you know what this is. This is a Federal Reserve note. You know them as a dollar bill. And if you look closely at the face of this Federal Reserve note, you'll see in the middle of the left-hand side is the letter K. It's surrounded by 2 concentric circles, and to go back to Wendy's introduction, the outer circle says Federal Reserve Texas, Bank of Dallas. And one thing I did learn at Oxford, Wendy, as I was learning English and how to read, you'll see on the surface of that note, 11 is printed in 4 corners, and you may know that K is the 11th letter in the English alphabet. There are 12 Federal Reserve banks. So we are the 11th district. K is our number, our letter. I don't think the Soviets could ever have figured out that secret code that we have right there. We are responsible at the Federal Reserve Bank of Dallas for administering the business of the Federal Reserve's affairs in the 11th of the 12 districts. And that was under the act created in 1913. We had 2 central banks in our history. The first Bank of the United States in Philadelphia lasted 20 years and went bankrupt. The second was closed down after 20 years by Andrew Jackson, who ran on a highly populist basis. And we went for 7 decades without a central bank in the United States, and we rolled, as Wendy knows better than anybody else, from crisis to crisis to crisis. And then after what was called the rich man's depression, after the Knickerbocker Bank failed in 1907 and spread that depression around the world, it was actually as bad or worse than the depression of the 1930s. One man ended up controlling the financial system of the United States and essentially became the central bank of the United States of America. His name was J.P. Morgan. President Wilson decided that that was not sustainable, and several members of the U.S. Senate on both sides of the aisle, as well as the Congress, then created the Federal Reserve of the United States, and we are celebrating our 100th anniversary. Just so you understand the basics of what we do, because I know you want to talk about policy, and probably during the Q&A, I'll go back to what was just on the screen. This is your folding money. There's $1.2 trillion in circulation at any one time and has been almost forever, at least my 10 years in the Fed. People need to have folding money. It's printed by the Bureau of Engraving and Printing at the behest and request of the 12 Federal Reserve banks. So the folding money in your pocket will have a letter on it. A is for Boston, B is for New York, C is for Philadelphia, et cetera, all around the Federal Reserve Bank of San Francisco. And of course, you know, as Texans, those ones with the K printed on them have a higher value than all the rest of them in the system. Why? Because we represent an economy that is 96% of our population of our coverage, covering 27 million people, over 360,000 square miles. Texas is about 96 or 97% of the output of my district. We have a sliver of Louisiana, northern Louisiana, what I call the productive parts of Louisiana. And then we have the southern New Mexican area. And that is serviced by the Federal Reserve Bank of Dallas and our 3 branches, which are in Houston and San Antonio and El Paso. El Paso, by the way, is the oldest branch in the entire Federal Reserve System. There was a rule that you had to be able to get money to people within a 2-day train ride, and when the Federal Reserve was founded, you couldn't get to El Paso from anywhere in 2 days. And so we still have them processing a great deal of cash. Understand this, I am not a federal employee. I work for a private bank. The 12 Federal Reserve banks and their employees are not federal employees. I have my own board of directors. And my board until recently was chaired by somebody I think everybody here knows and cherishes in this community of Texas, the founder of Southwest Airlines, Herb Kelleher. So I not only had one of the business icons as my chairman, I had the largest consumer of wild turkey bourbon in the world as my chairman. Our bank is a $180 billion bank. That bank also operates at a profit that we send to the Treasury. And indeed, the 12 Federal Reserve banks collectively, just so that you know the numbers, have transferred $321 billion to the United States Treasury over the last 4 years from our operations. So you're looking at one of 12 people, and maybe the only 12 people, that serve in a quasi-government capacity through a private enterprise that pays down the federal deficit, even though that's not enough. So just so you understand what we do for those 27 million people in the 11th district, we provide the cash that they need. We run them through our vaults. Last year we distributed and received 6.4 billion Federal Reserve notes, banknotes, you call them dollars, worth $118 billion at face value. And we have these mammoth machines that scan the cash at an average rate of 100,000 bills per hour to detect what's good, what needs to be replaced, what's old, and what's fake. And last year we just called out a couple of hundred counterfeit bills. People always ask me that question. We pull out about 1,000 a month. And then we pluck out 33 million Warren dollar bills, and we shred them, and we send them to what I call money heaven. We put them up a chimney, and then we replace them. So we also maintain the nation's payment system. We run a check processing. Checks, I don't know, we older people remember what they are. The younger people have no idea what they are. So both physical checks, which are now reduced to being processed in one single Federal Reserve bank, as well as the electronic payment system in the United States, what we call Fed ACH. And last year we processed through that 9.4 billion items, and this is a stunning number. That had a dollar value of 118 trillion, and then we have our FedWire transfer network, which we processed 101 million electronic transfers with a total dollar value of $524 trillion. Another important function of the Dallas Fed is to provide liquidity. This is one of the most important things we do to all the banks, and every member of the Texas House has a bank in their district where we have provided that bank with overnight loans just to square their books to operate against a very strong collateral. I approve these loans personally. I'm chairman of the credit committee because I'm a former banker, as Wendy mentioned. And just the other night, I approved a loan for $10,000, and I've approved loans up to $8 billion on it for an overnight purpose. Of course, the period where we had the most stress was right after the crisis and during the crisis. For example, in 2009, we made 594 loans at the Dallas Fed for a face value of $30 billion. In 2010, we made 156 loans for about $3 billion. And then in 2011, 12, and 13, and this illustrates the transition we've made in the economy, combined, in those 3 years, we made only 366 loans for a little more than $3.1 billion. It's very rare for us now to make a loan because there's so much liquidity in the system. And then last, before I get to the issue of our economy in Texas, we of course have the responsibility for supervising the banking system. We have 500 banks that we supervise, banks, savings and loans, and bank holding companies that we supervise through the Federal Reserve Bank of Dallas, and we just supervise them for safety and soundness purposes. So currency, payment processing, banking supervision, being a lender's bank, Those are the operational side and how we make our money and make a profit in addition to the portfolio that we've been building. And I'll talk about that, I'm sure, in the Q&A period. In order to make those payments back, the profits that we make, we pay a preferred dividend to our owners, who are private banks, who subscribe to being members of the Federal Reserve. And then we pay, after that preferred dividend, the profit back to the Treasury and not to ourselves. That's what makes us different than a publicly traded company. So let's talk a little bit about what's going on with the economy. And this will give you a perspective of where we are in terms of our own monetary policy. I'm going to show you a little dashboard. This is an invention of the Dallas Fed. It's sort of my way to get quickly oriented. And I just want to point out where we are presently. Some good numbers came out this morning and yesterday in terms of industrial production in particular. But the economy is beginning to get into what I call a nice little coasting. It's not robust, but it's not bad. Year-over-year growth of 2.6%. We've recovered almost 95% of the jobs that were lost during the Great Recession. We at the Dallas Fed, being Texans, calculate inflation differently than the rest of the Federal Reserve System. We calculate a trim mean. That just means that for a series that goes back to 1977 that covers 170 items that people actually use, from going to the hairdresser to filling up their gas tank to guns and ammunition to the cost of funerals, the latter two not related. And according to our calculations right now, the 12-month run rate for the trimmed mean inflation is a little less than 1.5%. And the official numbers for the CPI just came out yesterday, and it shows that number, the Consumer Price Index, running at 1.5%. And if you trim out food and energy, it's 1.7%. So we're in that region of 1 to 2%. I'm not uncomfortable with that. I am a hawk, as they call it, in the aviary of the Federal Reserve, and I will not tolerate, nor will I vote for policy that might lift that rate beyond the 2% long-term target that almost every central bank in the world has. And very, very importantly, given that we were mandated by Congress and given our license and our independence, unusually in central bank world, to have to monitor two variables instead of just price stability, but also under an act that was passed, we also have to create monetary conditions so as to achieve, over the intermediate term, full employment. It's a very difficult mandate for us to fill because we can only partially provide the gasoline, as it were, for that to be done. You have to have good fiscal policy, and you all know there is no fiscal policy in Washington, at least none that incents people to put money to work. But right now, we're running an inflation rate that's, an unemployment rate that's coming down to about the 6.5% level. It's a little bit higher than that. And I believe we're moving in the right direction. I want to focus just real quickly on these little two ones on the left here. Something that worries me, which are the spreads, and I'll come back to that at the end of my discussion, but I see a little bit of speculative activity in the economy, and you see it most prominently in terms of really junk credit, triple C rated credit, and the kind of spreads that they have and their yield that they're yielding are near historic lows. Let me just give you a perspective on where we were last November, and that's the blue arrows. So we haven't seen much of a movement on the inflation front. We've seen the unemployment rate come down, and we've seen growth pick up. And of course, again, the junk bond spread and junk bond credits, just as an indicator of speculative activity, of money chasing yield, has been still coming down. So we've made progress on several fronts, but we still have a little bit of more speculative activity in the market, and that concerns me. I want to turn to manufacturing right now and non-manufacturing. I want you to remember that manufacturing is a very small part of our economy. We all talk about it. It's like agriculture. It's deep in our hearts. It's part of America. But we live in a world that has been globalized and cyberized, and really we are a service and consumption-driven society. But both of those indicators right now are running above their average, and 50 means, given that this is a dispersion index, as they call it, it basically means that we're in good shape from the standpoint of not being up at those peak levels, but we're right around the expansion average. That means the average of economic expansion, and I'm comfortable on that front as well. Jobs are important. And if you look at the latest U.S. jobs report, it confirms that our weak December and January numbers, some of which have been adjusted, but if you look at those four in from the right, we're very much weather affected. 3 out of the 4 census districts in the United States were frozen. And if you were to break it down, thank God we weren't, except for maybe, I think there was one day in San Antonio and a couple days in Dallas and Fort Worth, and maybe one day in Houston. But the rest of the country did suffer from the freeze, and it's come back, it's bounced back nicely. One of the things we like to look at is the initial claims, and we feel that the Dallas Fed, that this is the best single indicator. If you had to just pick one to look at, I see Wendy nodding her head, so therefore I know we're right. But you can see the claims continue to come down, and that just means that the unemployment rate is moving in the right direction, which means lower. Real quickly, in terms of what we have done under what we call our large-scale asset purchases, and most people refer to as quantitative easing, I want you to see what we have in our portfolio right now. This is not just the Federal Reserve Bank of Dallas. It's all 12 Federal Reserve banks at the behest of the Federal Open Market Committee, where we make policy. And these are numbers that I think are of some concern. As you know, we've been buying mortgage-backed securities in order to turn that market when it reached its crisis level. We've gone through a couple of phases of that. And then we've been buying United States Treasuries. And right now, as of March 2014, our par holdings of fixed-rate MBS, mortgage-backed securities, exceeded 30% of the outstanding stock of these securities. And we're buying roughly 100% of the gross issuance of mortgage-backed securities. And you've seen what's happened with mortgage rates. They came way down. And as we announced, we're going to be trimming these purchases, which I will tell you, honestly, the third round I voted against, and I was against. I think it was too much. But it is a committee. We decided for it. We've seen rates come up a little bit now as we've begun to trim off our purchases. And we own roughly 25% of the stock of Treasury coupon securities. Now, having purchased Treasuries further out on the yield curve and done so in size, we've driven down nominal interest rates across the credit spectrum to lows that have not been seen in over half a century. And for a while, we had the lowest interest rates in the United States in 236 years. So this is an unusual period. There is a negative aspect to this, and there's a positive aspect to it. As I like to say, those that work by the rules save their money, particularly people, not teenagers like Wendy, but people getting old like me. I'm now 65. When you get older, you begin to become more conservative. You come on in the yield curve, and you put your money shorter, and you take less risk. Those that play by the rules, those that save their money, have gotten the short end of the stick here. This is a cost-benefit analysis. It was a painful decision. And I want you to know, as fellow Texans, I argued that ferociously at the table. But the decision was made by the committee that there were benefits. And this is certainly, in one case, and we know this, has allowed U.S. companies to re-leverage themselves and reconstruct their balance sheets. There isn't a day that goes by that you don't read of some major issue of bonds at lowest historical rates in order to refinance the balance sheets of U.S. corporations, public and private, large, medium, and small, in order to take advantage of these low interest rates and position themselves financially for eventual growth. And we see it in corporate bond yields and the spreads. They are very low. You see it on this little spread here. Even again, those that are least creditworthy are enjoying the lowest interest rates in a very, very long period. And the counterpart to that is that when interest rates come down, the way you discount future cash flows to invest in stocks changes. The hurdle rate becomes lower. And we've seen a response in the equity market, which has been rather radical, up over 2.75 times since the bottom, which I believe was March 9th of 2009. And yet, so far, inflation, which all of us worry about, every central banker in their DNA fears inflation, and this central banker, it's down to my toes. But so far, the inflation that we calculate as a trim mean, or the more official one, which is the personal consumption index, is running below the 2% standard target, which we have adopted at the Central Bank of the United States, but is basically the target for all central banks. And that's the brief I wanted to give you, the brief on the U.S. economy. Now, let me give you Texas brag. Let's go to Texas. We are the job-creating center of America, and you should be proud of it. We added 278,000 jobs last year. We grew our employment at 2.5%. And so far in 2014, we've been growing jobs at 2.9%. That's 54,400 jobs. Manufacturing is not done as exquisitely as we would like, but our overall output is expanding, and construction and energy are very strong. And if, I know you listened to Keith Phillips, who's a brilliant forecaster. I'm going to brag on him in just a second, but we expect through his work and the work of our economists and what we're seeing so far that our growth of employment will be running around 2.8% this year. Here's the brag part. We're the best in the nation. You knew that. But this is a very interesting chart. If you look at the blue lines, which is Texas versus the red, we continually outperform the United States. And in the period of 2008, we created 100% of all jobs in America. Look at that red bar. Without us, it'd be much deeper than it is. Now, I always have to deal with this when I speak to foreigners, people from the New York Times, for example. Because I always say two things. One is, well, of course, you know, all you guys do down there is oil and gas, right? So I thought you might find interesting so far this year, and this repeats a pattern we've seen, from left to right is the percentage of our labor force. So in trade, transportation, utilities, 20% of the Texas labor force. In government, by the way, 15%. In education, health services, 13.2%, and so on. Oil and gas, extraction, and mining, including the support facilities for that, legal, auditing, et cetera, 2.5% of our employment here in Texas. We are highly technologically driven. And if you look at every sector, this is this year so far, with the 54,500 jobs that I showed you on that previous slide, the only sector that has a little bit of a loss in terms of the thousands of jobs, 2.9 thousand, that's 2,900 jobs, has been manufacturing. We continue to bull ahead, and the number one job creator so far this year has been leisure and hospitality. People come to San Antonio, people come to Austin. I'm going to say this because I love you, dear. They'll even come to Fort Worth. So the result of all this is that our unemployment rate has been lower than the nation, and it's come down to 5.7%, whereas the nation is around 6.7%. Remember that we're doing this as the denominator grows. When you measure unemployment, you have a numerator, which is the jobs that you have, versus the people that are seeking jobs. I've seen studies, and I haven't verified them, but we have recently read that 1 million Californians have moved to Texas in the last 10 years. Those are the smart Californians, and we'll see who follows. And we're seeing emigration, as you know. We have very powerful numbers here. People vote with their feet in America. They have a choice. We are criticized for having poor social services and lots of social issues. They don't have to come here. They come here to look for a job. Jobs are the route to dignity, and we provide them. And that's what we should be most proud of. Both the manufacturing sector and the services sector within Texas are expanding, and this chart shows this. We have a couple of surveys. That TMOS is our Texas Manufacturing Outlook Survey, and the TSSOS is our service sector. We have a sub-index of retail. When you read the Wall Street Journal, you'll often see them referred to the Empire State Index, which is that the New York Fed conducts for what was once the Empire State, New York, or the Philadelphia Fed Index. You should be proud of the fact that the Dallas Fed Index since 2004 has been the most reliable indicator of activity for the entire nation. But it's hard to get the press to change their perspective over time. So this is a good for us, but it's also a good for the rest of the United States in terms of what we're seeing happen more broadly, and that was confirmed this morning by the industrial production numbers. I want to talk about home construction because everybody wants a home and everybody has a home, and it's part of the American dream. Look at these multi-family permits here in Texas alone, and our residential housing starts as well are way up. We are a state that is heavily driven by trade, and I did notice, and I actually brought with me, and I know you'll be able to read it from where you are, but this wonderful piece in the Dallas Morning News the other day about the ports in Houston. We are trade-driven, and this gives you a few numbers here, and it, of course, gives us some bragging rights. We are the biggest waterborne conduit of foreign trade in the United States. This isn't what comes by air to Alliance or DFW or Houston or elsewhere in the state. This is purely cargo tonnage. And it's increased almost 25% in the last 5 years. But very importantly, look at the number of jobs that Houston Port supports. 53,952 jobs. And what it means in terms of revenue is about $178.5 billion in an economy of Texas, which is $1.4 trillion. that's a significant contributor to our economy. This little pie chart that will show you where we send things to, and I love this because, and I'm sure the secessionists among you, including my old father-in-law, Jim Collins, would love this. I like to take some data and pull Texas out of the United States. And I want you to notice that if you take Texas out of the United States, from the peak of 2008, total trade of our country is only up 2%, whereas our trade and export growth in Texas is up 24% since the peak. So we have a lot that we contribute to the rest of the country here. Now, having downplayed petroleum products in terms of only 2.5% of our employment, and it's about 11% of our GDP here in Texas, it is important to be honest here. A lot of this expansion of trade that we have has been petroleum and coal products. Look at the green line there. We provide refinery products and other products and petrochemicals, and we are the greatest exporter of these for the United States, and that's what keeps us way ahead. Although we have a good mix of products, and you saw in that pie chart, it's not just Mexico, but it's also going to China, it's going to Latin America, it's going elsewhere, and it's getting more and more diversified. We do forecast based on Keith Phillips's good work, continued growth, and I want to brag on him for a second because I want to show you where we have been in terms of our forecasts versus the consensus of all the forecasters that you read about in the newspapers. Some are very good economists and very good people, but our Dallas Fed model, which is built by Keith Phillips, I think has the best record so far, and this is testimony to that. Now, the other thing that I love to debate with my foreign friends from New York and California is this argument that they make. Yes, you create jobs, Mr. Fisher, Ambassador Fisher. They don't call me that. But all you do is create low-income jobs in Texas. Not true. So once again, I asked our economists to take us out of the United States and give me a chart of the 4 income quartiles. And this actually is very disturbing to me because the middle income quartiles are the backbone of our nation. These are people that work by the sweat of their brow. They're not the rich, they're not the poorest, they're the backbone and the heart of our economy. And if you look all the way back to the year 2000, we've seen job destruction in the 2 middle income categories for the country as a whole, but not for Texas. So I want to put the blue bars up there because the red are US minus Texas. You should be proud of this. Yes, we do create a lot of low income jobs. That is true. But look at the amount of high wage quartile and the middle 2 income quartiles, which are the most important, I think, for self-respect. And as you know, the key issue here is to make sure that there's mobility. But if we're doing well in all 4 quartiles, you're likely to have greater mobility than not. So this is the source of pride for me, and I show it every time I speak, particularly when I'm in foreign countries, as I said earlier, like New York. Let me go back a little bit to 1990, give you more bragging rights here. This is the growth of our employment against selected states. Our employment has increased at 63% from that period, from 1990. And you should say a prayer for Michigan. If you had 100 jobs in 1990, you have 105 jobs today. And for New York, you'll have 109 jobs. So we are very blessed to be where we are, and we do create a lot of jobs here in Texas. I want to break this down a little bit further just to show you where we are in terms of the different metropolitan areas, because I know you represent everyone here. And Austin may be weird, but man, it does well economically. And this is quite a striking, this is 1990 to today in terms of the business cycle indices that we compile. And this to us is the best indicator of how the different areas are doing. On the right, we have McAllen and El Paso and Brownsville, Harlingen, and Laredo, the border areas. And of course, El Paso is heavily dependent on military spending, as you know. And Laredo has been the beneficiary of our cross-border trade, as has McAllen. So, Edinburgh. So I'm on my way to Edinburgh, Scotland. I've got to get these 2 things straightened out. But again, on the left, those numbers at the lower line aren't too shabby, but Austin, Round Rock are very, very impressive. So the summary is the following. The U.S. economy is picking up following a harsh winter. Texas employment growth, again, accelerated in 2014. We grew at 2.9%. Our job force and our job creation, 55,400 jobs were created in Texas. We expect roughly the same pace this year, maybe slightly lower. And then the question is, how can the state maintain its rate of growth? And that's where you all come into play. I want to make a couple of comments here. We operate under the same monetary policy as the rest of the United States. The 12 Federal Reserve Bank presidents get together with the 7 governors of the Federal Reserve System. Those 7 governors are appointed by the President of the United States, confirmed by the United States Senate. Your husband voted to confirm me as a Deputy U.S. Trade Representative, as Ambassador. The 12 bankers are not. We are totally independent. We have our own boards of directors. Mine are composed of 9 citizens from this great state and then also from New Mexico and Louisiana. And we create monetary policy. And the real issue is that we cannot sufficiently on our own create policy to make this country grow. I'll use a simple analogy. I referred to it earlier. We provide the gas for the engine of the economy, money. And we have been expanding the monetary base at an unprecedented rate. We have enormous amounts of bank reserves sitting on our balance sheets, $2.25 trillion. Banks would rather lend that money to businesses to operate. But you have to have demand for those loans. And bear this in mind, depository institutions in the United States, those that keep their excess reserves with us, are only a quarter of our credit system. We have bond markets and we have other credit vehicles. So there is an immense amount of liquidity out there. And the problem is that we have a fiscal policy that doesn't incent people to step on the gas pedal, use the gas that we've overfilled the tank, in my opinion, is brimming with liquidity. But you got to have someone take their foot off the brake, step on the accelerator. And unfortunately, the Congress of the United States is so divided and providing no incentive whatsoever for businesses, in my opinion, to actually use the money and invest it here in America, other than Texas, and put it to work. We have the same monetary policy as the rest of the United States, and we grow. And I'm convinced it's because the legislators and staff in this room. I hope you won't be offended, but it is a good thing you only meet for a limited number of days every 2 years. I wish it was 2 days every 140 years, but I know we're stuck with you. And it's a good thing that whoever's been the governor's mansion and whoever's been speaker and whoever's in that assembly has been pro-business and has created incentives for us to use capital. I think we're very good at taking advantage of these low interest rates. So the question I raise is, why can't others do this? And the answer is either other state legislators or the federal government provide too much disincentive. And that has to change. And I'll just stop this part of my speech by just reminding everybody that we won. Ronald Reagan said, Mr. Gorbachev, you take down that wall. The wall came down. Mao is dead. Ho Chi Minh is dead. Pol Pot is dead. We have some odd behavior in Russia, and that's a separate story. It's a minor economy. We won, and we got what we wanted. I'm 65 years old. Wendy's 35 years old. But my entire generation was spent in fear of mutually assured destruction. We thought we'd be nuked, and we would nuke them. We went from mutually assured destruction to mutually assured competition. That's what we wanted. When I would travel with President Carter, we would go to G7 meetings. Now we have what I call the G-Whiz. Everybody's a member. There's G20s and G this and G that. And I just came back from China last Wednesday night. And they have a different system we do, but they're part of the system. We want them in the system. Now we have to outcompete them. And you've got to give, in Washington, businesses incentive to go out there and compete against others who want to create jobs and take away our business. And they're just not doing it. So they're letting money lie fallow. And I just wanted to mention that you cannot count on the Federal Reserve alone to do its job, and you don't want. We're not the elected representatives of the American people. They have to do the job of crafting a tax system and a spending system and cleaning up the regulatory mess we have in order to incent people to use the gasoline that we create. I said I would conclude with a question, and the question that I want you to think about is with regard to our own state and the issue that I personally find the most vexing. And that is something that a little bit different than what Keith Phillips talked about earlier, and it's the issue of water. I think this is our biggest challenge long term. And the question is this. Well, first let me give you a little background. If you look at the demand side for water in the state of Texas, particularly if we see our population expand at what our demographers are telling us, which is that we'll double in size over the next half decade, so we'll have 46.3 or so Texans. That'll annoy the hell out of everybody else in America. But that just means that we're going to go from consumption of 18 million acre feet per year to 22 million acre feet per year. So demand is increasing. And right now we have a pretty even supply. Keith may have mentioned this, but it's basically irrigation needs and, of course, municipal needs, a little bit for manufacturing, a little bit for mining, a little bit for livestock and so on. Demand is increasing. It's going to increase significantly. Supply is decreasing. It'll fall over the next half century from 17 million acre feet to 15.3 million acre feet, roughly a 10% decline according to our studies at the Dallas Fed and also at the Water Board. So that's not a pretty picture. The question is, what's it going to cost? And if you fully address the state's water needs over the next half century, we estimate it'll cost $231 billion. That's the total budget for the biennium. Madam Representative, you know that. We're talking about big numbers. And you can't count on the appropriately named rainy day fund to fill that need. So you're going to have to figure out, those of you that incent people in our state to continue to outperform and deal with the ultra painful issue which this group cares a great deal about, of taxes. How are you going to finance it? Are you going to tax our children and grandchildren? These are 100-year plus projects. And I just gave you the numbers for half a century. Or are you going to borrow? You can't count on the rainy day fund. That's $17 billion. It's a drop, no pun intended, in that big water bucket. So the question I have to you, and the thing I'd like to challenge you to think about is, here we are at the Federal Reserve. We've pushed interest rates to the lowest currently in the last half century, and for a brief period, the lowest in the history of our country. We have about $3.1 billion in Texas water debt outstanding. We know that we're going to have a number that's over $200 billion in needs over a half century. That's a very long-term project. And you have to decide if you're going to do it through taxes or you're going to borrow. I want to make a slight observation. The shrewdest operators that I've seen in the recent credit cycle are those who went out and borrowed 100-year money. They borrowed 100-year money at MIT, for example. Mexico just issued a sterling 100-year bond at 5.25%. Mexico is 4 credit levels lower than Texas to match their long-term needs and to diversify their debt portfolio. We're at a very low ebb, and you can see it on this chart right here in terms of AAA rated corporate debt. We are a AAA rated credit here in Texas. We have a higher credit than that of the United States, which I also like to point out to the rest of my colleagues. And I'm not going to give you any predictions of when the Fed is going to move to the short-term rate and when rates are going to rise, but I will tell you this, and this is on camera, and we're being streamed on Bloomberg and covered by the Wall Street Journal. Here's a prediction. Interest rates will rise in the next 100 years. You heard it here. Now, this is a tough subject, but you really need to think it through. And how you would, if you were to go down this route, as some very smart people have recently done, in order to satisfy the demand. For example, the insurance companies who want long-term debt are desperate for it. Sovereign wealth funds who have are desperate for it. The demand for each 100-year bond that's been issued over the last 2 years has been oversubscribed by 3 to 1. I hear great concerns about this topic. One is you don't want to do a general obligation bond because you never know who's going to end up either in the governor's mansion or in, I don't think you'll be around for the next 100 years, might replace you. And you don't want someone reckless to have that freedom of that money sitting in a pot somewhere. So it has to be tied to very specific management for a specific purpose and not just for someone just to play with. And I understand that concern. Another is, well, you fellows at the Fed are creating the tinder for future inflation. By the way, it's something that I am personally deeply concerned about, and I have mentioned this in meeting after meeting. with all that money sitting aside, when it comes back, when what economists call velocity picks up and comes back into the economy, we're going to have to manage that uber carefully, otherwise we're going to create inflation. But let's say the critics are right and we create inflation. These interest rates are mighty attractive because it will devalue the income stream that has to be paid out. But I do ask you, whether you decide to tax the people or figure out a clever way to borrow against that uber long-term need, you need to solve this problem now. To me, that and education are the biggest problems we have in the state of Texas. And on that happy note, have a nice day. Thank you. You want me to answer? I'd be happy in true central bank fashion to avoid answering any questions you have. So, yes, sir.
What is the role of the Federal Reserve now, having changed its policy and paying interest on the reserves and the excess reserves?
That was mandated by Congress. We pay 25 basis points, is 25/100, so 1% per annum for the money that's left in excess reserves with us at the 12 Federal Reserve banks. Now, I don't know any banker in their right mind that's satisfied with that return. They'd rather lend money to a commercial customer or some other entity between 4 and 6% or whatever they can get. But no, this was something that was changed by Congress. We used to pay nothing, and we have to follow the law. But I don't think that's the incentive for banks. I mean, it wouldn't be incentive for me, and I don't think it'd be incentive for you. They'd rather be out there lending to good customers. And if you don't know what your taxes are going to be next year, and nobody in this room knows what their federal taxes will be in the next budget cycle. If you have no idea how federal spending is going to be reconstructed, and we know it desperately needs to be, and if you feel like most Americans that you're hyper over-regulated, and then you have new things and Affordable Health Care Act and all these other things that have come on stream, and the Federal Register is getting mega-gigantic. Mega-gigantic's an economist term. What that does is create just a fog of uncertainty. Wendy was nice enough to say that I don't have a PhD in economics, I'm an MBA. I'm very proud of that, by the way. But first thing you learn first day of business school is what is decision-making in businesses, decision-making under conditions of uncertainty. That's what you're trained to do. But if you have total uncertainty, you can't make a decision. And I still see businesses, and I survey over 50 businesses around the country before every FOMC meeting, still in a defensive crouch. So what do? You drive your costs down. You control your SG&A. You basically manage your bottom line. You don't have confidence about growing your top line. And that means that your growth muscle, as I like to call it, gets a little bit weak. And you don't think in terms of adding employment as readily as you would or as we would like to see. We have to get that kind of clarity. And that's why people are not lending, and banks are not keeping it there for 25 basis points. But that's something that Congress put upon us a few years ago. Other question? Yes, ma'am.
A few years ago, I don't know, maybe a couple of years ago, Governor Perry wanted to bring our gold back from the Federal Reserve, and you were going to assist him in that. I want to know if you were successful in that effort.
The question is, where is it kept? How would we structure that? It's basically the gold that is kept at the New York Fed is to a great extent foreign central bank gold. It's a hyper-protected building that costs a fortune if you were to price it at current prices. And I understand the sentiment behind it, but I don't think it's a practicable recommendation.
So you didn't bring the gold, Texas gold,
No,
to
ma'am.
Texas?
All the gold in the Federal Reserve System is kept at the Federal Reserve Bank of New York. We are, however, the depository of quarters at the Dallas Fed. I have a lot of space in my vaults, and don't ask me why, but we are. Yes, sir. No, but anyway, ma'am, I don't think it's a practicable thing, but I understand his sentiment. Yes, sir.
Yeah, thank you for your overview of the economy. It was excellent.
But.
What I didn't hear is like there's a branch of government that you've ignored in your comments. You talk about Congress and what they should do. I think there's an executive department.
Yes.
Also.
Well, I put the two together, fiscal authorities.
Okay, so but you seem to be looking to Congress to do something, but the executive department, and you refer to the regulations, they
You're right.
What could they do with what they have available to them to address some of these things?
Well, again, I'm not an elected representative of the people. Obviously, I'm not President of the United States. I'm President of the Federal Reserve Bank of Dallas, a little deal. And I'm not a member of the lower house, the upper house. I hesitate to make specific recommendations, but I'll make a simple recommendation. You should be thinking at all times about how we create more jobs in America. And whether you are an R or a D, or you're sitting in the White House, or you're sitting on Capitol Hill, there are a lot of social issues that divide this country. I happen to deal in the monetary realm. But again, the route to dignity is through work. And I would devote every ounce of my attention to how you incent people to create jobs in America for Americans. That should be their focus. And we have a tax system that does not encourage that. We have a spending system that does not encourage that. And we have a regulatory system that discourages it. And I know you're all left-wingers in here and you won't like what I just said, but that's the way I feel. Any other questions? Yes, sir.
Mr. Fisher, two things quickly on the unemployment rate. A lot of talk about the percentage of adults in the labor force today versus 10 years ago.
Right.
And then what the number would be if it were compared to a standard from, say, 10 or 15 years ago. Can you comment on that?
Well, yes, sir, go ahead.
I'm sorry, I thought one more. What if the Fed were to simply waive the debt of the federal government?
We don't have that power.
You couldn't?
So set that aside. We are buying a lot of the debt of the federal government. We've suppressed interest rates, which has been helpful to them. In terms of the unemployment rate, here's the important point. We have the power to affect cyclical unemployment with monetary policy. We don't have the tool, monetary policy, to address structural unemployment. And there has been, and this is something I think a lot of economists are spending their time on, trying to understand what are the structural changes that have taken place. There's clearly a skills mismatch in this country, and I forgot to tell you that in Texas, in our surveys, we're seeing shortages of labor in IT, in engineering, in auditing, and even truck drivers. I mean, you try to find a good truck driver in West Texas, or even try to sign anybody to work in West Texas because they have low unemployment rate. So we have skills mismatch. And let me speak about a truck driver for a minute. If you drive a truck for Frito-Lay, you're running an inventory. You have to do four-function math. You have to program something. It's not just being behind a wheel and stepping on the gas pedal or the brake. So this is becoming evident in our state, and we're seeing a skills mismatch around the country. What does that tell you? Our education system is not addressing our needs. Our immigration system is not addressing our needs. And taking advantage of those that come here, get high-skilled training. They come to UT, by the way. You all finance them through state dollars. They go to a private school like Wellesley, like Wendy did. They're financed by their endowment. What do? We graduate them and we send them away. It's like drilling a brilliant well that's a great producer. You bring it up to the surface and then you give it away to another country. That doesn't make sense to me. So we have a skills mismatch. We have an immigration issue that has to be solved. And we're just going to have to figure out also what impact did the Great Recession have on the baby boomers like me, who may have been incented to retire a little bit earlier and not go back and rejoin the labor force. But here's the point. We at the central bank cannot affect structural unemployment. And again, ultimately, the Congress of the United States and the executive of the United States working together, if they could only just focus on what do we need to do to incent people to create more jobs. That will help on the cyclical front, and if we get really tight, on the structural front. But we have a long way to go right now. One last question from the distinguished-looking gentleman in the back with the mustache.
Thank you. The last couple of years, the Fed has been buying, roughly 60% of the federal government's debt. Is it because you're just dying to buy the debt from a deadbeat, or is it because nobody in the world wants that debt? I mean, are we at the point where China, Saudi Arabia, Japan, et cetera, really don't want a whole lot of American debt, and if the Fed isn't helping, we can't sell it, therefore we couldn't finance some of the deficit spending?
No, in fact, if you look at the flows, more money's coming into this country now than ever before. We are number one, and we will stay number one. And I just came back from China, and they own a lot of our debt. I'm grateful they do. I want someone to buy it. I wish it weren't being issued at the rate it's being issued, because we have to cover our deficits. And we have this cumulative problem over time, and then we have what no one talks about, which are the unfunded liabilities of Medicare, Medicaid, and Social Security. I'll give you a number that'll scare you on that. We calculate at the Dallas Fed those three unfunded liabilities, particularly the Medicaid side. Its current present value, if we were to pay off the promises already made to the American people today, is over $90 trillion. That's what your Congress has done, and your executives. I'm going to add that out of respect for you. So no, but I gave you the numbers of what we now hold in terms of stock. And the purpose of that was to, when we cut interest rates to zero, you can't go further than that, so you have to increase the money supply. When we buy something, we pay for it. So let's say we buy a treasury bond from you, and we're further out on the yield curve now. We don't own any short-term paper. Again, this is unprecedented. We pay you, and you take that money and put it somewhere. Now, the other side of our balance sheet is the reserves that I spoke of, because people, basically the banks, which is 25% of the credit system in the United States, has taken that, what we gave them, and put it back with us in terms of reserves and excess reserves. So it hasn't gone into the economy. The purpose was to drive it into the economy, and then change the discount factors so that the stock market would rally, which it has, and the bond market would rally as well, and that would put relief for the business creators, the job creators of America, which is the private sector. So we've done a lot of that, obviously. Again, I was against QE3. The whole world knows that. I thought after $2 trillion, that was a big number. Now we're up to a balance sheet that exceeds $4 trillion. And we've never been here before. And I'm worried about what do we do as that money comes coursing back. It'll be a nice problem to have, in my view. I want to see it go back into the economy. But that's the reason we conducted what's called Operation Twist. It's the reason we have bought all these government securities. Those are treasuries. And then in addition, of course, as I showed you, we've been buying a lot of mortgage-backed securities. And right now we're buying at a monthly rate. We've reduced it, which I'm grateful for, not having been for it in the first place. We're only buying $55 billion a month, split between treasuries and mortgage-backed securities. At the end of last year, under the law that governs corporations, I have to personally testify to our balance sheet, and I'm personally liable. So I stay up through New Year's Eve, sweat, and then I sign off on the financial statement for the Federal Reserve Bank of Dallas. I had $91 billion in treasuries on my balance sheet and over $60 billion in mortgage-backed securities on my balance sheet. I didn't have a single loan outstanding. So I have a very unusual balance sheet. And when under the laws, when you have to sign and you're personally liable, it just makes you think about these things. So, but people are still willing to buy our debt. We are buying an awful lot of it. And I will not deny the fact that, in my opinion, we've made the rich and the quick much richer than ever were before. Whether or not our program has actually benefited those middle-income quartiles, only time will tell. I want to thank you for having me here today and for putting up with me and for the gracious reception. Thank you very much.
Thank you.
So, Mr. Ambassador / President Fisher, you do know what Phil Gramm used to say about why he became an economist, right? Because he didn't have a good enough personality to be an accountant. But my point is that I think you, opposite of what Senator Graham might say, not about you, but about economists, including himself, I think you have such a gift to really boil down for the ag majors from Texas A&M in the room, from the Stanford, Harvard, and Oxford educated. I think you have such a gift to boil down what's important. And what we've been able to do, and so many of the legislators in this room, and really such a great collection of people here and across the state, what has been accomplished in the state of Texas through the policies that you just talked about. And it's just a real gift to have you here and to have you leading the conversation on these incredibly important issues that are facing our state. So with that, I thank you. Wendy, I thank you for joining us today. It was really fun to have you here, and our incredible group of speakers that we joined with, and all of you for coming and spending your day with us. There's no question what Mr. Ambassador President Fisher said, that we do have some pretty significant challenges facing Texas. But that is why this organization and so many of you work so hard and so tirelessly to defend and to think about and to come up with the solutions to better our state, not only for ourselves, but more importantly for our children and for our grandchildren and those who are coming behind us and for the rest of the country who are watching. So thank you for coming, and we'll look forward to seeing you at the next event. Thank you.